Welcome to our next episode of Financial Minds Meet the Experts. I'm Jaime Agostino, your host. On this show, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today on Financial Minds Meet the Experts, we are joined by returning guests, Fred Eisel, Chief Investment Officer at Vizo Financial, and Tim Sustak, Chief Credit Officer at Vizo Financial, to discuss their favorite topic, the state of the economy. Welcome back, and thank you for joining me today.
Thanks for having us. Yeah.
All right, well, let's dive right in. Inflation has recently shown some signs of easing. Do you think we will continue on this path, or will inflation continue to persist? Which one of you want to take my first question?
Tim, take it away.
Well, the honest answer is who knows? You know, that's the honest answer. But I think hopefully we've seen the worst of it. Obviously there's a lot of things in play out there. You know, we still have all the crisis war going on in Ukraine, pushing energy prices around. We still have, issues in the auto industry with chip supply and vehicle supply and things like that. To state a couple of the obvious ones. But I think, hopefully we've seen the worst of it at this point. But I think, we just don't know. It's just so hard to see what's coming in the future. I think what we do know, though, is that the Fed is steadfast in wanting to bring down inflation. So I think, we won't see an end to rate increases until we see some substantial progress on inflation. I don't think we have seen that yet. So that's the one thing, all these other things in the background, we really don't know how those are going to play out. But one thing I am fairly confident in listening to the Fed, listening to Fed presidents speak, is that they're steadfast. I don't think they're going to turn around quick. I think the folks that think, oh, yeah, we saw a little break here in inflation data, the Fed's going to get soft. I just don't see that. I'm not buying into that. I think Chair Powell will keep them moving towards squashing inflation and won't back off soon. I think he's cognizant of what's happened in the past, and I don't think he has any intention of backing off until he sees some real progress on inflation numbers coming down.
All right.
I would agree. I would completely agree with that. I think that I'm on the same side where, my call is inflation probably has neared its peak, if not peaked already. As we've talked about in previous podcasts, the Fed admits that they were late to the game. They were saying transitory last year, most of us, and two of us in this call said that was kind of false, and they have come to terms that was false and they were late to the game. So the inflation that we're seeing today has been brewing for a while because of our pandemic spending. So that's why the Fed's been so aggressive this year to try to fight it. So I think they're on top of it. I agree with Tim that they're not going to ease up anytime soon until they find that inflation's heading in the right direction. I'm with Tim as well. I think it's probably near, if not at its peak. I think it's going to stay higher and trend lower a lot slower than people believe. The markets believe, as Tim has mentioned, that the Fed is going to get to a point, worry about putting us in a recession and ease up on the rate increases and kind of take their eye off the ball on inflation. I agree. I don't think they're and if you listen to Fed speakers, not just Chair Powell, but all the other Fed participants, they're very concerned about inflation. They're going to stay on top of monetary tightening until inflation's controlled. I think it's going to trend lower, like I said, but stay elevated a lot longer than the market thinks. I think because of all the things Tim has mentioned, I think you got a lot of wage pressure. The employment sector is extremely tight still. You see that wherever you go. Everyone's still looking for employees. Wages are going higher because of inflation, but for other reasons as well. So I think is stickier, stays around longer, which means the Fed's in the game longer. They may not be raising rates as aggressively as they did this year, but I think they're going to continue to raise rates, tighten policy till they're confident the trend has headed lower. And they're not going to back off like the market believes. I just think they know they're late. They were late. They're going to move on this and stay on top of it until they have it under control. So hopefully we've seen the peak. It eases lower at the end of this year and the next. I just think it's going to take a lot longer to get back down to that 2 to 3% target the Fed wants. It's going to take a little longer than next couple months. A lot of these rate increases, they always say, whether it's an increase or a rate cut, take about 6 to 9 months to be felt into the economy. They've done a lot of rate increases this year. So a lot of these have not been felt yet, have really bled into the economy. It's going to take till the end of this year into next year. So I think next year we'll start to see what truly is a trend of inflation, and hopefully it's under control.
All right. Unemployment fell from 3.6% in June to 3.5% in July, returning the national unemployment rate to pre-pandemic levels. Do you feel with such a high employment rate, we could fall into a recession?
I think I'll start with this one. I think the high employment rate, very low unemployment rate is the reason why we may stay out of a recession. The ultimate goal is a soft landing, as they always call it, which is next to impossible, where the Fed can raise rates to manage inflation at the same time for the economy to continue to grow slightly, and we kind of get out of this little funk that we're in. That's very difficult to pull off. But we are in a unique situation in this economy because of the pandemic, very low unemployment. We, the consumers, are still spending. Retail sales were off a little bit the last month, but if you look at the PCE, which is the inflationary number that the Fed likes to look at, inside that report was some retail sales, kind of the control group of, as they call it, retail sales, and that was up. So the last few months have been adjusted upwards. We are still spending money, us consumers. We're spending on goods as well, and because we're employed. And as I said earlier, everyone's looking for help, whether it's McDonald's or Vizo Financial. We have had job openings. Everyone's looking to fill roles, and it's very, very difficult. So as long as that stays the case, that does put pressure on wages, which of course puts pressure on inflation. But I think that also helps this economy get close to that soft landing, because we are at a very tight labor market right now. I do believe that unemployment will go up slowly as the Fed continues to raise rates. Do we get into a recession? Possibly. The Fed will never admit it, will never say it, but we kind of need to go into a recession because there's no way they can fix the supply chain issue that Tim mentioned earlier. They can fix and control the demand side of the equation, which is raising rates. So we've been in such high growth for the last 2 years during the pandemic. We do kind of need to back off a little bit and kind of sort of go into a small recession. The Fed kind of wants to see that a little bit. But with the unemployment rate so low, I think that's going to help the Fed considerably continue to be aggressive on rates because our labor market's still so tight. So does that keep us out? I don't know. I still think we go into a recession sometime next year, but I think if we do, it'll be small, hopefully small, short, light, and we can get a very close soft landing.
All right, the housing market. So the housing market appears to be in a recession. Will this impact the credit unions?
I can start. I mean, yeah, certainly with the increase in mortgage rates that we've seen, the housing market has slowed down, to say the least. I mean, I think most metrics you'll see out there in the housing market have backed off. We're starting to see prices start to come down a little bit in certain places, and certainly refi activity down. Fred just sent out an article today. Some of the non-bank lenders in the space are having troubles now because of the back off in activity. I think certainly credit unions see that too. Mortgage lending has become a more important part of credit unions' balance sheets, but certainly with the increase in rates, we should see that activity back off. And then I think along with that too, with buying new houses or building a house, there's always those other spends at Home Depot, Lowe's, where have you, for other things to go with the house. So we may see some of that activity back off. So maybe certainly home equities or just personal loans as well. As people, don't spend on, remodeling the kitchen in a new house they just bought, right? So I think it certainly will slow lending activity. And then, nobody's expecting this slowdown to be like what we saw during the financial crisis. But then too, you just have to watch for, with as fast as home prices shot up, if we do see a reversal there, depending on where you made those loans, you get a little inside out on that if you have to, worry about problem loans. So hopefully we don't really get there in a big way, but something to watch as well.
Yeah, I think I agree with Tim. I think, we're coming from a spot that was an uncontrollable, out of control mortgage market for the last 2 years. So if you were in the market for a home or building a home, or even today, if you read some stories in New York City and some other big cities trying to find a rental apartment, we were in a spot that it was just absolutely out of control. So that needed to be brought back down to earth, back to a more normal, which, the Fed increasing rates and the 10-year treasury going up increases mortgage rates, and the mortgage rates can go up to 7, 8, 9%. They're still around 4 and a quarter, 5. So historically very low. Now they're not as low as they were, last couple of years, around 3%. So that's kind of spooked a lot of people. But mortgage rates are still very low. We have had a lack of home supply for years. This isn't from the pandemic. We're talking since the financial crisis, which really impacted the mortgage market considerably. So we've had a supply problem for 10 years, 12 years. Everyone kind of changing their lifestyle, work from home, want to stay at home, put more money into the home, want to move out of the city or move to a different part of the country altogether. It's just putting significant pressure on housing. But for the credit union, and you look at some of the lenders that were exclusively just mortgage lending, they're laying off people right now because it was so gangbusters. They loaded up employees. That market's kind of gone away. So they're going away. But the credit unions should be in a good space. There still will be mortgage demand. As Tim mentioned, I think home equity lending has already started to trend higher. We see that in the data, and we've heard it anecdotally from credit unions that have talked to us at different conferences that home equity lending has picked up because home equity values are much greater now because the home value is higher. And without any stimulus or any other type of money, you put on a credit card, but if you want to build a pool or do some additions to the house, there's so much more equity there with still very cheap funding that home equity lending, I think, will be the kind of the point where the credits come into play. They can step in to where the lenders are now gone or struggling for funding. They'll still be there as a consumer and their members' point of purchase, hopefully for the mortgage. But I think home ec is where has already started. I think that will be the future in the mortgage side for credit unions going forward. So they still have an opportunity. It'll be much slower than it's been the last couple of years, back to more normal, which is a good thing overall for that market.
All right. Well, you're kind of leading into my next question. So will these higher interest rates impact the lending in the credit union industry or the demands for the loans? Are we going to see, uptick in other areas, with the mortgage kind of coming down? Are we going to see, you said home equities are up. What about autos?
I think I'll start there, Tim. I think mortgage lending there'll still be a demand. I think there was so incredibly unprecedented demand that got the headlines the last couple of years. I think there's still a lot of people in a lot of pockets of this country still looking for a home and a mortgage. So mortgage lending will be there, even with higher pricing and higher yields or rates. There'll be demand there. I got an email from a credit union last week asking about for a friend. Should they borrow now on the mortgage and wait for a rate's going to go up or down? We're at that pocket of time where if you're getting your mortgage today at 4 to 4.5%, rates going up or down are not going to be, I don't feel they'll be significant enough to wait to buy the home now versus 6 months later because the rate's going to go back to 3. And I don't think that's going to happen. Nor do I see rates going to 6 either. So I think the consumer's so used to low rates, they're waiting for the perfect time. But there's going to be a lot of consumers, especially in the summer months that we've just kind of finished, that folks are going to look for the home. I think higher rates are just going to be the norm. People are going to get comfortable with that. They're still going to want a home. They're going to still want to move to the right school district. There'll still be demand. Home equity is already increasing, even with higher rates, because those are typically tied to prime, are increasing because consumers have that equity. They feel comfortable with that. Auto lending is still going to be strong. That you just need to have autos to buy, and that's a supply chain problem. It's probably going to last into late end of next year. But used and new car loans will still, I think, be quite strong, even with higher rates, only because cars are getting older. We have a demand for those. The supply has still not been fixed there either. So rates higher will kind of, mute lending a little bit. I just still think the consumer's in a good spot financially. Rates are still historically low, and we still have a lot of demand on the auto and the home side, enough to, I think, provide a lot of good value and a lot of good flow for the credit union.
I think,
Tim?
yeah, I mean, some of what we've seen just in talking with credit unions, I think, this rise in rates and anticipated future rise in rates has actually sped things up, especially maybe in the auto space. where, folks are trying to get those loans done before the Fed continues to go on this rate hike path that they're on. So we've seen a number of credit unions say that, hey, loan demand has really increased rapidly, over the past few months. Some of them expect that to back off then going into maybe the fourth quarter as rates continue to rise. But we don't know. We'll see. But I think it's certainly gotten some people off the fence that may have been there.
And what we're seeing too is liquidity tightening fairly quickly. We were very liquid as a corporate first of this year, which means a lot of our credit union members were very liquid and depositing their overnight cash with us. We kind of figured and projected that liquidity start to dry up throughout this year. It's dried up a lot quicker than we thought. And talking to credit unions, as Tim said, lending has kind of ramped up significantly. In the meantime, the consumer's spending down some of the excess cash, their stimulus money or whatever, thanks to higher gas prices, higher inflation. But just generally, we are still spending money back to kind of pre-pandemic levels. That's kind of a concern for us, is for credit unions that were so flush with liquidity the last couple of years during the pandemic. This year, we're seeing kind of that trend change, moving the other way, and going into 2023. I think if loan demand still stays strong, not like it has been, but strong, meanwhile the consumer continues to spend, liquidity will be kind of the topic du jour in 2023, which no one thought it would be. I think liquidity will be a bigger topic to discuss into next year, and creditors are going to need to look for funding. Going to have to look for offer higher rates under, they've been used to offering very low to next to nothing on money market accounts and checking accounts, savings accounts. I think that world's changing too in the end of this year and the next, where they're going to have to offer a little bit of higher cost of funds to attract or retain funding, because the liquidity picture has changed quite quickly this year.
Absolutely. So based on all of this, do you think the Fed will raise rates another 75 basis points in September? Tim, what do you think?
I think if we continue to see numbers like we have seen the next, inflation and employment releases, I think they'll go with the 50 rather than the 75. If inflation surprises to the upside, I certainly think that 75 is in play.
Okay.
Fed has said as much.
So you're not giving an answer, Tim. You're
I'm saying
a true economist. It depends. It all depends.
Right. It all depends. I'm saying if things are as they are now, I'm going to say 50.
Yep. And I would agree. But I would say I'm more in the 75. There's still a lot of data yet. They don't meet till the end of September. So there's some data yet between this podcast and the next Fed meeting. We got some time. It's data dependent. What I would say is I'm probably more in the 75 basis point camp, because there's a lot of economists, a lot of folks in the market that think the Fed can't go much further. They'll hurt the market too much. And I think the Fed may send a message. My hope is they're going to send a message that, no, we are going to raise rates, tighten policy to get inflation under control. It's still very high. I think I'm hoping they do 75 to kind of put some of the market to bed that says, yeah, they can't go too much. They're going to be dovish and weak on inflation. I want the Fed to be strong, go against the market and say, hey, we're serious about this. We're doing 75 here in September. Continue to look at the data and maybe ratchet it back to 50 to 25 ongoing. To just let these rate increases this year bleed into the economy into next year, stay on hold, or 25 the next couple, and kind of ease into it. So I'm more in the 75 camp, but there's a lot of time between now and then, and 50 would not surprise me either. So I'm giving you no answer either. No answer.
Well,
I'm playing both sides.
I am hearing you're leaning towards 75 and Tim's leaning towards 50.
Yes.
So
yes.
we'll find out come September which one of
September, one of us is buying each one of us lunch. So that's it. Yes.
All right. So any final thoughts for our listeners, Fred?
The final thought is what I've just said. Is keeping an eye on, for the credit union, keeping an eye on the data and the economic announcements in the next few weeks. The Fed will move rates for sure in September. 50 or 75 is the debate for everyone, not just Tim and I. But they will move again in September, so prepare yourself for that. Would not shock me if they move a little bit more in their November meeting. Don't expect them to stop and cut rates next year if we go into recession. I think they're okay with a recession. They will not make that public. They won't say that. But we as an economy probably need to go in a little bit of recession here to kind of ease our demand a little bit. And the second piece is just for credit unions to keep an eye on liquidity. As I said, I think that's going to be more of the talking point as we go into the end of this year and the next year, where the liquidity picture that you saw in 2020-21 is going to be completely different in the next year because of what's going on. I think the economy is going to be okay. Unemployment's still going to be pretty low historically. So I think the consumer is going to be in a good spot, still spending money, and with higher prices, going to spend money quicker. That liquidity and cash may be more of a concern next year. So just keep an eye on that.
All right. Tim, any final thoughts?
Yeah, I think Fred said it well. I don't really know, have much to add there other than yeah, I mean, I think rate increase is the base case for any economic modeling you're doing. I don't expect anything to back off there. And, stay vigilant as far as, pricing of deposits. I think, Fred talked a little bit about that before. We haven't had to worry about that in some time. So, with loan demand up, the last thing you want is to have deposits really start to walk out the door, and there may be enhanced competition for that going forward. So some things to keep an eye on that we haven't watched for a while. So,
all right.
I don't know if it's appropriate or etiquette to have like a lunch podcast where we can eat lunch the next time we do this and can discuss who bought who lunch while we're eating that lunch. So that's the bet right now. So next podcast, we'll see who's buying who lunch.
All right. Sounds like a plan. As always, thank you both so much for joining me today. I really appreciate it. And
thanks for having us.
Thank you, Jamie. Yeah.
Oh, you're welcome. And thank you to Double Check for sponsoring this episode. Non-sufficient funds and overdraft fees are outdated. With a member-controlled Double Check solution, you can let your members be in control of their transactions while still generating income for your credit union. This solution gives your members the option to choose which transactions are paid and which ones are returned, shifting the responsibility from your credit union to them. As an added benefit, Double Check is easy to implement and it integrates directly with your core and digital service providers. To learn more about Double Check, contact your Vizo Financial corporate account manager today. Thanks for listening and make it a great day.